Today you'll have a different kind of video to introduce our next module. As you saw in the lesson yesterday, we are talking about accounting and finance, two areas that every business person needs to know something about, particularly if you have a managerial role or you own your own business. You need to be familiar with the basics of both accounting and finance. That's what this module will talk about. So let's talk about, first of all, accounting. And we'll talk about how that works, what that's all about, and what the owner or the manager needs to know to run the business efficiently and, in the end, to make a profit. On your screen, you see something called a spreadsheet. This is from a computer program called Excel. Some of you may be familiar with this. But on this screen, you see that there's something called an accounting cycle. We'll walk through this. And basically what the accountant has to do, or the bookkeeper who keeps track of money for the business, what that person has to do is to manage the funding of the business, to make sure we have accurate records in the business, because money comes in, money goes out, we have to pay bills, we make sales. So someone has to keep track of all that, and the owner or the manager needs to be familiar enough to understand what those records tell him or tell her. So let's take a look at, first of all, something called an accounting cycle. And this is what basically it sounds like. There is a cycle of events in a typical business that goes sometimes for a period of 1 month, sometimes a period of 6 months, sometimes a year, depending on the size and the type of business. But some things happen, and eventually that cycle runs through and it starts over again. So let's run through the basic parts of it. First of all, business transactions take place. So if you have a business or you are working for a business, something's going to happen. You're going to sell something, you're going to buy something. That's called a business transaction. Typically, money's involved. That's where the accountant or the bookkeeper keeps track of all of this. So the accountant or the bookkeeper, as it says here, records these transactions into the books of the business. Basically, accounting talks about two kinds of books. One is called a journal. That's kind of a chronological, day-by-day record of what happens in the business. And the other is called a general ledger. A ledger has a series of accounts. These are pages that indicate a particular customer or a particular creditor, which means somebody we owe money to. And we can look at that account and see how much the customer owes to us, or we can see how much we owe to a creditor. We have accounts that keep track of the cash, that keeps track of a number of things, as we will see. So this is where we start. A business transaction takes place. If we follow the arrow down, the first step then, after that transaction takes place, the bookkeeper or the accountant puts the information into the first book of the business. This is called journalizing. And again, the journal is a day-by-day chronological record of what happened. So we need to keep track of that information, obviously. So that's step one. Step two, from the journal, the information is then put into the other book of the business, the general ledger. And this process of taking money from one book and putting it into the second book called the ledger, that process is called posting. The next step, at the end of the accounting period, then, and again, as I said earlier, this accounting period could be a month long. Very often it is a month, but it could be 6 months, it could be 3 months, it could be a year. It varies from business to business. So at the end of that time, at the end of the period, the accounting staff, the bookkeeper, whoever that might be, creates some financial statements. And we look at basically two of them. One is called a balance sheet, one is called the income statement. And as the manager or as the owner of the business, you would need to know how to read these and make sense of these two financial statements. After that, then we start over again. We begin a new accounting period. So that's the accounting cycle, and we'll talk more about that. And I want to spend a little time right now with this last part, this last step, where we looked at these two financial statements. I want to show you what they look like. So let's go to this page of the on the screen, and you see these two statements for the XYZ company. On the left is something called a balance sheet. On the right is the income statement. And they do two things. The owner or the manager needs to understand that the balance sheet is like a snapshot. It shows the health of the business on one particular date. This happens to be the end of February 2019, and this will give you some information about the business on that particular date. Incidentally, if this business is a large corporation, the owners of the business are called stockholders, and there may be hundreds, there may be thousands of stockholders. If you own a share of stock in a corporation, that means you are an owner. So periodically, you deserve to get these financial statements, and the corporation will send them out to you. And it would be helpful if you know how to read them. Now, these are fairly simplified. A large corporation has a balance sheet and an income statement that would be much more complicated, but this will give you the basics. So this is the balance sheet on the left. On the right is the income statement, and this talks about information for the entire month. As we said, this business has an accounting period of 1 month. So this is what the income statement is talking about, information for that month. Let's look at what's on the balance sheet over on the left first of all. There are two sides of it. One side has what we call assets. The other side has what we call liabilities and something called owner's equity. And these three things comprise what we call the accounting equation. Down at the bottom you see this. The accounting equation is this: assets equal liabilities plus owner's equity. Or another way of stating it, assets minus liabilities equals owner's equity. Now let's take a look at what those terms mean. Assets on the left of a balance sheet. All of these things are what we call assets. An asset would be something that the business owns. They have something of value. Obviously, cash is valuable. Accounts receivable is an account that keeps track of money that people owe to us. Even though we don't have it yet, people owe money to us, so we will be receiving that money. So we count that as something of value that we own. Inventory, these are items that we will eventually be selling. We may own an office building. Even though it may not be paid for yet, we still consider it an asset that we own. We own some office furniture, some computers, some office supplies, and we own a delivery truck. And again, maybe that delivery truck is not paid off yet, but we still consider it as an asset. So the left side of a balance sheet has values for each one of these assets. And we add it up, and we have a total asset amount, in this case $557,900. On the right side, the other side of the balance sheet, we have a category called liabilities. These are things that the business owes. These are debts of the business. And let's take a look at some of these. Accounts payable. This is something that indicates that we owe money to somebody else. We bought some supplies at some point. Maybe we charged those supplies. And so now that's part of accounts payable. We owe money to somebody. We haven't paid them yet. We owe, in this case, $112,000 to a number of people probably. Another liability is a mortgage on the company building. We looked over here. We have an office building worth $200,000, but we haven't paid it off yet. We still owe money on that. The mortgage means a long-term loan. Basically, that's what a mortgage is on something called real property, in this case, a building. So we owe $150,000. So the building is worth $200,000, and yet we still owe $150,000. That's a liability. That's something that we owe. We don't have to pay it right now, but we have to pay it eventually, probably by a monthly payment over several years. And here's a loans payable on the delivery truck. Again, we said we have a delivery truck worth $30,500, and here is a loan. We still owe $21,000 on that truck. That's a liability. And same way with the computers. We bought some computers, and they are assets over on the left side, but we owe money for those computers. So we have, in this case, four liabilities, and if we add them up, we have a total of $286,000 that we owe. And if you would subtract that number, the amount that we owe, from the amount of assets that we have, you subtract the two, you'll get $271,900, which is the owner's equity. That means the value that the owner has. If there's one owner, he or she has a value of this business worth $271,900. So that's the key number that the owner would want to look at. Does this go up every month? Does it go down? Does it stay the same? That would be a question that you should consider if you're looking at this balance sheet. And the bottom line here, if you add these two, liabilities and owner's equity, you get $557,900, and it balances the total assets. And that's part of what we said down here is the accounting equation. And then finally, let's take a look on the right side. The other income statement, or the other statement, the other financial statement, is called an income statement. And this is what we sometimes call a profit or loss statement. It shows how much money the company is making. The XYZ company for the month of February of 2019 has a net income, which means profit, of $1,175. So that's how much money the company made during the month of February 2019. So obviously that's something that the owner would care about and want to take a look at. So how do we compute net income? Really very simple. We take revenue. Revenue means income, the money coming in to the company. In this case, total sales. This doesn't indicate what we're selling, but we're selling something apparently. And during the month of February, we sold $10,000 worth of something. So that's called revenue. And we simply then add up all of the expenses of the business, and then that gives us a total, $8,825. We subtract that from the $10,000, and we get the net income. So net income is a simple mathematical process. You subtract the total expenses from the total revenue. That gives you net income. If total expenses would be higher than the total revenue, then you have a loss. Then you lost money. But let's take a look at these. These are the expenses: rent expense, advertising, gas and oil, electricity, electrical expense, and heating expense. So this is how much we spent on each of those during the month of February. Now these are expenses which are different from liabilities. The basic difference for our purposes is this. For a liability, in all of these, we're gaining something of value. Now we have a mortgage, but we get the building. That's the offset. That's the good thing. We have a loan on the truck, we have a loan on the computers, but we get the truck and we get the computers. So we gain something. All these accounts payable, this doesn't indicate what they're for, but we got something. We got furniture maybe, we got supplies maybe, but for the basic information that you need to know about liabilities is that they get something in return. We owe money, but we gain an asset in return. These are different. Expenses are necessary costs of running the business. We have to have them. We don't get something in return. This tells us that we are renting a storage building. That's not the same as the office building on the balance sheet. We have a storage building. It's not ours. We are renting it. So we don't get that. We don't own that storage building. We just simply have to pay rent. Advertising, gas, electrical, heating, we don't actually get something. We have to have these. We have to have gas and oil to run the delivery truck. We have to have electrical power. We have to have heating to keep the office building going. So we don't get